On to some top stories then. Now, the West Asia conflict will push up prices, but it will also likely harm US growth and job prospects. Analysts now see this as a Fed rate cut delayed rather than a hike story. That is unlike in 2022, when a demand shock combined with a supply shock fueled inflation and led to rate hikes. The outlook for Fed policy changes has been changed by events in the Middle East. Financial markets have swung from anticipating 2 quarter-point rate cuts this year to now pricing in barely one. Markets are solidly backing a no-change outcome on Wednesday. The military action in Iran and the resulting reluctance of shipping to navigate the Strait of Hormuz has led energy prices to spike higher. US retail gasoline prices up above $3.6 per gallon. This will put up the supply and disruption costs, with airline fares also likely to push higher. The longer that disruption lasts, the greater the chances it lifts prices in other sectors as well. In consequence, analysts bet on inflation moving towards 3.5% by the summer, which is well above the 2% target. Given the situation, the Fed's new forecasts become extremely important. In December, the Fed penciled in one rate cut in 2026 with further in 2027. There is huge uncertainty over how long and how intense the conflict and disruption will be. So the Fed will have little conviction in their forecasts this time. Fed Chair Jerome Powell will certainly underline the challenges in setting policy at the press conference. Nonetheless, the central bank will trim growth marginally, push up their inflation forecast and delay the rate cut. Now, to unpack this further, we are joined on the broadcast today by Robert Quebb, the Director, Asia Pacific Geoeconomics and Business Initiative at the Chapman University, live from Los Angeles. Welcome to the show, Professor Quebb. Thank you so much for joining us today on WION. Now, firstly, let's talk about some macro factors. How significant could this energy shock be for the US particularly, as far as the inflation in the coming months is concerned?
Well, it's very significant. So inflation is measured with the most volatile components being energy and food. And actually, there's another dimension to what's happening in the Gulf, and that is not only do you have this shutoff of oil exports, you also have a shutoff of liquid natural gas and fertilizer. So you've got all the key components that are the most volatile elements of inflation just having upward pressure. So yeah, it's very consequential.
Right. Like you pointed out, it's going to be consequential. But as per your estimates, how do you feel the Federal Reserve should balance rising inflation risk with the possibility that higher oil prices could slow economic growth and hiring?
Well, this is the trick, right? So the Federal Reserve has what's called a dual mandate, and they're supposed to maximize employment and keep prices stable. But there's not a lot they can do other than, like you were talking about, changes the interest rate. They had already reduced it previously, and to reduce it further now just makes no sense because of inflation. Job growth isn't too bad, but the more the economy, if it starts to slow, there will be pressure for them to make some movement. But as you also mentioned, if you have inflation running well over the target of 2%, they're really not permitted by an act of Congress to do too much. So they're just, holding steady is going to be the one thing they can do. The rest is really up to the federal government.
Right. Holding steady is what the strategy could look like right now. But Professor Quebb, if this disruption in the Strait of Hormuz lasts longer than what is being expected, could the Fed be forced to keep rates higher for a longer time?
I mean, it's exactly as you say, keeping them higher. So not raising them, but not lowering them. It's really going to be a matter of more wait and see. The thing that would shift their policy would be if inflation got way out of control, in which case they would have to, in fact, raise interest rates rather than lower them. Or if employment really plummets, which doesn't look likely so far, but if the situation gets worse and worse and job growth significantly slows and we enter a recession, then they might just have to accept higher inflation and reduce rates in order to juice employment.
Right. So in fact, we could see a rate hike instead of rate cut this time around. But, at this point in time, given the current scenario, how many rate cuts or hikes could possibly is what we could see in 2026? What are your estimates suggesting?
Well, I don't think the conflict is going to go on indefinitely. There doesn't seem to be an interest for that from the White House. The American public wouldn't really be behind that. There's a big backlash against what has been called forever wars. And so it's unlikely to have the pain last as long as would be necessary for a rate hike. It's more likely to see a rate reduction, but that's going to be put off until at least the end of this year. The general thinking is it will probably be December. And it could go beyond that. It could go to early 2027. But so far, the general expectations, if the conflict does not last much longer, would be we'd see one rate reduction by the end of this year and then maybe another in 2027.
All right. So if this doesn't last long, one rate reduction by the end of this year, another one in 2027, the start of it, that is. But Professor Quabb, just a month ago, the market was pricing in multiple rate cuts for 2026, right? Now, with this conflict now in the third week and oil prices hovering near that $100 per barrel mark every week, has the Fed's data-dependent path, do you believe that has effectively been hijacked by geopolitics? Is that the key focus now?
Not yet, but you're right. So it's data driven. What they really look at is personal consumption expenditure. So it's not even exactly the same as CPI, the Consumer Price Index, which is talked about more in the press. But this PCE core inflation measure, that does actually strip out energy and food, but it's already without that very volatile food and energy component been running high. It's actually 3%, which is way above the target of 2%. So with that in mind, the data is going to be very important. If inflation gets much more severe, yeah, they're going to be even more hawkish.
Right. They could be even more hawkish if inflation gets more severe. But Professor Quabb, US is now a net exporter of energy, right? Yet domestic retail gasoline, that is imminently pushing towards that $4.25 per gallon. Why do you think this shale shield is not protecting the American consumer from the global supply shock?
Well, it's rather complex. So the U.S. energy mix still relies on imports. And like I mentioned, it's not only energy, it's also the components of food and the ripple effects in the global economy regarding energy consumption and pricing. You, in the previous comments, talked about airlines having higher fuel prices. So it's more globally interconnected than to just say the U.S. can switch to just supplying all its own energy needs. In fact, a lot of the energy companies, one of the reasons we're not entirely self-reliant is because the energy companies know they can make a lot from overseas markets and they have overseas contracts. So you can't as simply switch it over. If this were a prolonged conflict for years, yes, that kind of transition would happen. But for right now, Americans are just like consumers elsewhere in terms of energy, gasoline prices, still subject to the geopolitical pressures.
Right. So that's about the impact on the American consumer. But lastly, Professor Quabb, talking about the leadership within Fed, President Trump has nominated Kevin Warsh to succeed Jerome Powell. Now, historically, Warsh is known for longer hawkishness. Do you think this war sort of provides the perfect inflationary cover for a shift in the Fed doctrine towards a more restrictive stance than the current one?
Yeah, like I said, the war just creates a hugely volatile condition. I would say the other thing, too, is although hostilities, I think everyone would hope they will cease sooner rather than later, but assuming it's not a prolonged war, things like liquid natural gas, which I mentioned, is often overlooked. There's such a focus on oil, but liquid natural gas, it takes longer to restart that process because you have to have super cooling going on. You have to go to negative 162 degrees Celsius to liquefy gas. So that to restart and the ripple effects that has. For example, China is heavily dependent on not just oil, but LNG from the Gulf region. So in any case, the whole global economy will be affected, and then that can ripple back to the U.S. So I would just say that it really is going to be a matter of wait and see. We'll have to not only watch the conflict, but then see once the conflict ceases, which it hopefully does soon, what the restarting of the energy supply chain as well as the fertilizer supply chain will take.
All right. Thank you, Professor Quell, for taking us through that perspective. And tell me if I'm rightly summing it up. For now, looks like the rates are going to be steady, and probably in the end of this year, that is in December, probably we could see another rate cut, and thereafter following in the beginning of 2027, right?
Yeah, sometime in 2027, but that's assuming the economy grows the way we're hoping, that things like tech and AI continue. There's not a bubble there, but it's more about growth spurt. Yes, that would be what I would estimate.
All right. Thank you, Professor Quell, for joining us today and helping us with that perspective. On that note, we'll let you go.
My pleasure. Thank you.